Divergence detected. The Treasury just sold $25 billion of 30-year bonds at the highest yield since 2001, and the 30-year closed at 5.25%. Software and cybersecurity took the hit. We end today on the #1 ETF and stock this scan surfaced, and the result isn't what you'd expect. SPX notched its third consecutive weekly gain near record territory, but QQQ formed a lower high divergence right at that same ceiling, and VIX stayed unusually quiet through all of it. The scan picked up a perfected exhaustion count on SPX, alongside a bearish divergence in junk bonds. Over 74% of NASDAQ stocks are holding above their 200-day moving average. So breadth isn't broken, but the headline and the chart aren't saying the same thing. If SPX is at highs and the NASDAQ is stalling, the back end keeps flagging the same question. Where is the actual setup quality concentrated right now? The divergence gets sharper when you see what the macro parameters are actually showing underneath it. DXY slipped below 100 on cooler macro data, while the long end of the bond market pushed hard in the opposite direction. The 30-year closed at 5.25%, and the Treasury's $25 billion auction of 30-year paper cleared at the highest yield since 2001. That's the bear steepener at work, the short end easing while long yields stay under structural fiscal stress. U.S. net interest expense has already hit 20% of total tax revenues, the highest since the 90s. And the combination of a softening dollar and a stressed long bond is exactly what historically surfaces in commodities. Energy is the first place the system clocked it registering. WTI crude is holding a supply risk premium right now. Iranian tanker attacks and a stalled Hormuz situation are keeping the geopolitical bid alive in XLE and energy broadly. There's a divergence the backend picked up, though. Diesel forward contracts for September are hitting new highs, while WTI itself has been moving sideways, which is a fuel demand signal that doesn't line up with the crude headline. A record inventory build and IEA demand cuts are working against the supply story on the other side. So the energy setup is real, but it's not clean. And the same geopolitical supply logic that's putting a bid under energy is exactly what's filtering through into how metals are positioned right now. Gold and silver caught a relief bid on Friday, as the dollar's softening gave precious metals room to move. Fed hold conviction was tracking near 70%, and metals picked it up immediately. But the chart and the story don't fully line up here. Institutions are actually net sellers of gold right now, not buyers. So that bounce is running into smart money caution in the futures market. Copper had a sharp pullback to close the week, which adds another mixed signal to the metals readout. The cleaner structural setups the system surfaced this session aren't in metals. And the metals divergence is actually what makes the international signal stand out so clearly. International equities are outpacing domestic in the system's current asset class rankings, and the chip cycle is where that leadership is coming from most clearly. Taiwan, specifically EWT, has been one of the strongest movers in the scan, up over 41% on the back of semiconductor demand. Japan, through EWJ, reclaimed a buy signal and is pushing back above a key technical level, which is a meaningful shift. But that international strength is sitting right next to the most split signal in this whole readout. And crypto is where the system flagged the sharpest divergence. Bitcoin is trading below all three of its key moving averages, and the scan has this registered as a confirmed bear market structure for BTC USD. The 10-month moving average that held as long-term support for years got broken, along with the trend line running back to the 2015 cycle low, both falling in the same move. The bear market bounce topped out just under a major Fibonacci retracement of the full decline, a classic dead cat structure with no capitulation signal underneath it. BTC USD is now in tight range compression with a pending SEC catalyst still unresolved. And that coiled setup is exactly why the ranking engine's filtered shortlist is the critical next layer. It surfaces structure when the broad market is still deciding, with the 30-year closing at 5.25%. And the indexes slipping just under record territory. The structural question is whether equities are pricing in that rate stress. And the #1 ETF and stock this scan surfaced are still ahead. SignalFinder Pro's best of best took the full universe and filtered down to 147 symbols, ranked by structural setup quality, not by which names moved the most yesterday. What surfaces at the top of that list today is a direct readout of where the system sees durable leadership through a mixed macro backdrop. The top 3 sector ranking today puts XLV, Healthcare, at rank 1, XLF, Financials, at rank 2, and XLI, Industrials, at rank 3. What's notable is the signal state. Healthcare and financials are scoring at the top on structural criteria, while their near-term signal is lagging. And industrials is the one carrying the active leading designation. That answers the question this session flagged. Setup quality right now is concentrated in the defensive and rate-sensitive corners of the market, not in the high-growth names where the index divergence was most visible. And the ETF layer makes that concentration even sharper. ARKG is the #1 ETF from today's scan, the ARK Genomic Revolution ETF, a high beta basket of genomics and biotech names, topping the ETF rank in a session defined by rate stress. Note what it did not do. ARKG closed down 1.96%. This is a structural setup score, not a momentum read. The engine is ranking where rate sensitivity is building, not what rallied. The signal state here is wait, not a cleared timing signal. ARKG sitting at rank 1 on a day the 30-year closed at 5.25% is the back-end's answer to the divergence this session opened on. Top of the stock ranking today, QLYS, QLYS, a cybersecurity name in the technology sector, holding the #1 spot in this session scan. What makes that notable is the price action. QLYS closed down around 5% today, and it's still ranked first. The ranking engine is scoring longer-term structural leadership, not chasing the daily movers. A pullback inside a structurally strong setup can actually improve a name's standing relative to peers that faded harder. The signal state here is watch, flagged, not cleared for timing, which means this one stays on the radar as the price action settles. The 30-year closing at 5.25% after an auction at the highest yield since 2001. The divergence this session opened on turned out to be the exact structural force that showed up in the rankings. Rate stress at the long end and software and cybersecurity wearing it. The thing to watch next, does the 30-year hold this zone or does it break higher? Because if it breaks, the pressure on long-duration growth builds from here. Verify both signals live in SignalFinder Pro before drawing conclusions from today's scan. And remember, this is educational content, not financial advice, so do your own homework.